Welcome back. Let's check markets. European indices this morning are mixed. Down, the FT 100, down about 20 points, 0.25%. The CAC 40 in Paris is flat, and the DAX index is also flat, up a fraction. Investors across the world watching this British Prime Minister Theresa May and the UK's upcoming exit from the European Union. Now, Theresa May is facing backlash as politicians call for a second referendum on Brexit, with some even calling for a vote of confidence. Joining us right now is Vining Sparks Bank and Equity Strategies Director Marty Mosby. Marty, good to see you this morning. Thanks so much for being here.
Well, thanks for having me. Good morning.
We saw the British pound really fall about 1.5% yesterday, and that was a lot of the drama around Brexit. What impact did you see from Theresa May's press conference and those partners of hers that resigned yesterday, officials in the government?
Well, again, what we're looking at here in the United States is a buffer from most of what you're seeing with Brexit. When it was first announced, the banks as well as the market as a whole took it on the chin and really thought of the uncertainty. Now we're just kind of working through the details. Eventually they'll get to some conclusion here, but we've already seen the business is continuing, and it really is just trying to get to some finality about the relationships and where they want to go.
While we were seeing that impact markets, then we heard from billionaire investor and Tudor investment founder Paul Tudor Jones. He spoke at a hedge fund conference yesterday commenting about global debt. And he said from a 50,000 feet viewpoint, we're probably in a global debt bubble. Global debt is GDP, to GDP is at an all-time high. He said that we could see this bubble beginning to pop. He said that the Trump administration's corporate tax cut from last year could hurt investors in the future as the Fed continues to raise rates. Marty, you heard the comments yesterday. How important were they in the market, and what was your reaction?
Well, again, what we're looking at here is a way and an avenue. Bank loans are actually a lot less than what they've been in the past. One of the big complaints is we haven't seen more loan growth. A lot of that is that this stuff has moved into debt or the capital markets area. So it's just different avenues of funding growth. And then what we've seen is really the tax reform has created a lot of cash flow. So that cash flow for these organizations and businesses gives them the ability to pay back that debt and pay back some of what we're seeing in the lending side. So what we still see is some stability and health there.
Michael Block, let's talk about this for a second, because debt is an issue is not an issue so long as confidence is strong. But when do markets start focusing on the corporate debt levels and the federal debt? Is that an issue for markets?
You know, it's interesting. We're quoting Paul Tudor Jones this morning, great investor. And, there's another great investor, Ray Dalio, who's weighed in on this recently. And his point is there are various signs that lead to debt bubbles and this whole boom-bust cycle. George Soros has written about this as well in the past. The thing that Dalio points out is, there's an issue if there is high debt service levels that can't be met if they're in key entities. I know there's been a lot of talk about GE. There's been a lot of talk about the U.S. government debt here. We have to ask ourselves whether, A, is the U.S. government debt really making them struggle? At this point, the answer is no, and the bond market's reflecting that. And with GE, that hasn't been an important company. We were talking about this earlier for a very long time. We can't read into this. This isn't another subprime crisis. Could we have a corporate debt crisis down the road? Sure. Maybe if that's what Tudor's talking about, then he has a good point.
But Marty, don't you think that there is some increase in debt levels that is attendant to incredibly low interest rates for a very long time?
That's true.
This is not a surprise. I mean, if you keep interest rates near zero globally, companies are going to resort to raising debt, which is, I think, what Marty's saying, right? I mean, basically, this is the choice that companies have made, and now as interest rates start to go up, it'll change.
Well, I think that is exactly right. And what we're seeing is cash balances have expanded as well.
Right.
So the ability to repay is still strong, and we're not seeing a tipping point at this point. And household debt is actually pretty good. So what we're seeing there is a very strong household sector kind of weighing in as well.
Marty, I'm surprised to see Paul Tudor Jones sort of blame the Trump tax cuts for the reason that the credit bubble is going to burst. It seems to me we need the growth from these tax cuts in order to bring rates back up to something like a more normal level. Isn't tax cuts leading to growth part of the solution to the debt problem?
Well, we saw the numbers, 4.2% in the second quarter, 3.5% in the third.
Yeah.
Well, the GDP growth that you're talking about exactly is the cure for debt is the growth. What you also have is interest rates are still so historically low that the debt burden and the service for this debt is very digestible. So, as we're moving rates up, we're not seeing rates or expecting for rates to get back to what they were at their even last peaks. So we have a lot of room here to see rates up another 50, 75 basis points, 100 basis points even, and still stay at relatively low rates and very affordable levels.
Marty, real quick before you go, bank stocks down about 4% in the month of October with that October swoon. Would you buy financials here?
We would, yes. We think that financials are the kind of the canary in the coal mine, where when you think of this recession fear that kind of grips late cycle fears, the banks are the ones that get hit the hardest because of what happened in the last cycle. So I think we're trading the last cycle. If you look at fundamentals, earnings are continuing to move higher. Capital deployment is continuing to accelerate, and those are positives.
Marty, great to see you. Thanks so much. Marty Mosby joining us.